investor update. I'm glad you have time to join us tonight and that this is going to be a great presentation for you because we have a lot of great information. And I have been looking forward to this particular webinar and update, especially because of all the things that we've got going on that I want to share with you. As always, though, we will spend some time taking a look at what's been happening in the markets, as well as some other items that can help you create, grow, protect, and preserve your family's wealth in today's economy. I'd like to take a moment and thank all of our clients who've joined us, as well as the guests who've joined us tonight. We are so glad to have you here, and I will definitely, over the next hour, try to make this very much worth your time, so that you get what you need out of this to help you maximize what you're doing when it comes to wealth management for your family. As always, we have a few disclosures that I like to remind you of. Again, everything we take a look at here has to do with what we see as sort of commonalities for everybody. That means that it may not be perfect for you. There may be things that we'll cover tonight that are not best for your situation. And that's where, when it comes time to make decisions like that, you should talk with me, with your other counselors, whether that is attorneys or CPAs, whether that's bankers or real estate people, whoever, the people that you trust to give you good information, you should take time to do full and fair disclosure on everything before you make a final decision. Everything we look at here will be based on averages and analytics designed to help give us a picture of today, but specifically, your situation is unique, just like your neighbors, your friends, your brothers, your moms and dads, etc. We will have a time for questions. The questions will come at the end, and I will tell you, I have a jam-packed program tonight. We're going to be covering a fair amount of stuff, more slides than I normally do by about 10, and I'm going to be trying to cover a lot of information. My goal is to be done by 6:30, just like always, and so I will work hard to get that done. So I will try to get through everything and then have time for questions at the end. But please, if you have questions, feel free to, at the end, chat in the box what you'd like to ask, or you can raise your hand. I can see that, and then we can try to review the questions that way. And of course, if you don't get your question answered, as always, you can email us at the end of the presentation or in the next couple of days, and we'll be happy to take time to answer that for you. Tonight, we're going to go through the market and economic review. We're going to go through portfolio management diversification considerations. We're going to take a look at how to understand the power of wealth transfer planning, as well as I'm going to remind you about the wealth management apps and how some of our new processes make it so it's a lot better for you now than it was even before. Take time for your questions, and I'll remind you of the next investor updates for you and your guests to join us. So, as I've been covering the last few months, the good, the bad, the ugly, although in this case we're doing it reverse, the ugly, the bad, and the good. The ugly hasn't really changed all that much. I've made a few adjustments to it, but the price of oil is still high, although it's come down recently. Unresolved supply chain issues in some ways are getting better, but there's still plenty of challenges out there when it comes to supply chain issues. The Fed raising interest rates as they have, it may exacerbate a potential recession. And that possible recession and or potential stagflation, stagnation of the economy with inflation simultaneously, is certainly something that we're keeping our eye on carefully, as I know you are. The bad, there have been a fair amount of executive administration policies that I'm not quite sure have been good for Main Street. Some of them may have been good for Wall Street or for major corporations, but I'm not so sure that they've all been good for the average entrepreneur and business owner. Certainly, we've had deficient policies with transportation, energy, and homeland security, which I think is adding to the challenges we're facing right now, and quantitative tightening, where the Fed has stopped printing money and is actually pulling things back a bit as they raise interest rates. The good, despite the bad and the ugly that's there, there is good. And I think that's part of what the hopefulness is here, not to be exuberant, but to be realistic about what's going on. As I mentioned a moment ago, fuel prices have lowered recently. That's good. When will inflation improve? I will tell you, I was really hoping we might see just a tick down this last report, which we didn't. It was a tick up to 9.1. Having said that, though, if oil prices are able to come down a little bit lower and stay down, we might see that first reduction in inflation reporting in maybe the next month or two. that would certainly be a cause that would make the market celebrate a bit. The 2022 midterm elections typically are looking more and more like we're going to have conservatives in Congress, the House and the Senate, maybe have stronger positions, which could have a lot of positive impact. Another issue, the good is when or maybe how fast will the U.S. resolve supply chain issues, both domestically and internationally, something that we're watching carefully. How soon, when that happens, will we have return of business competition, restaurants and gas stations competing for price, sales that cause people to actually be like, that's a great deal, I got to go in and buy that. When will that happen? And hopefully that will be sooner rather than later, which would also be another good impact on the economy. When will or how quantitative tightening take effect? The goal with the Fed raising interest rates is they really want to slow down inflation. Hopefully that will have a positive impact. Although I would say that as many of you and I have talked in the past, as well as I see reports now, there is a lot of question about whether or not raising interest rates in this kind of inflationary environment will help with the recession or actually maybe trigger it more quickly. And that is one of the things we're watching as we listen to various reports from economists and CEOs talk about what they think is happening. Rising rates may help seniors though, because they might be able to make a little more money. Also, it could help corporations and individuals because they might make a little more money on their cash reserve than they were before. But again, if interest rates aren't rising that high, it may not have that big of an impact, but small favors, right? Record levels of individual and corporate money reserves are waiting. They are absolutely waiting for opportunities. They are looking for places to put money where they can make money, whether that is in higher interest-bearing accounts or it's investments like stocks or real estate. There's various pieces out there, and now all that money really seeks efficient return. And so all that money out there in the hands of individuals in forms of cash reserve or savings, and corporations who have extra money to set aside for other things they want to do, all of that is waiting for that opportunity. And then finally, down the road, the 2024 presidential elections, that's a long ways away, but I think once we get past the midterm elections, you're probably going to see some things heating up in that conversation. And as those politicians begin talking and there becomes this sense of where things are headed, I think you're going to see any of these pieces as they add a little more positive thought to the economy and the markets. I think you're going to see the markets react to that. Again, that doesn't mean we're out of this. We are not. I'm going to share with you why I think we're not, but we may not be as far or in as bad a shape as it might feel to some of us. So I mentioned market capitulation last webinar, last update. Market capitulation follows downtrends in which the stocks sell faster than they buy, and usually you'll have a period of time where it drops, and then you'll have another period of time where it drops after it tries to rally a bit. That activity is generally a response to fear, uncertainty, or doubt, what's called FUD, a bear market, which we're in for the S&P 500, poor earnings results, which we're not really seeing much of, negative company news, which we're not seeing much of, but there are some negative macroeconomic trends that we're watching, and those could be part of this as well. Having said that, though, as I researched a number of articles before this update, I didn't find anybody that was certain we have or are going to have capitulation. As a matter of fact, I found a number of experts who were of a mind that we might not see that capitulation. I don't know that I hold to that thought, but I certainly would hope that's right, but we're watching carefully as we try to make good decisions as it regards your family wealth. So I mentioned this last time, but I want to spend a little more time on it today, just to kind of remind you of what we're looking at here and how fearfulness can really sort of take over when it shouldn't. We should be calm, we should be cool-headed, we should be collected in our thinking about what we're doing here. And so what you're looking at on this chart is, let me get a little better pointer for you. Oh, guess that's not going to work. Huh. All right, sorry, that's the best pointer I can get for you. What we're looking at here is going back to the 1980 and going forward to 2022. We're looking at basically 42 years of history. The gray bars represent the calendar year returns. The red represents intra-year declines. And so for instance, here in 1980, we had a 26% return for the year, but we had a mid-year where it fell 17%. I'd like to point out that here the next year, we had a 10% negative, but at one point we were down 18%. And I can run all the way through this, but I want you to notice a couple of things. One, there's only 10 negative bars on this chart. Out of 42, 10 of them are negative, 32 are positive. 32 are in the positive return. So we're looking at well over 75% are positive. The second thing I want you to notice is we have positive returns with inter-year declines. Inter-year declines, quite honestly, in almost every year here. And then I'd also like to point out when we look at, for instance, 2020, the market ended up 29%, but it had an inter-year decline of 34%. And that was part of what we were working with. I'm sorry, I hit the wrong one. 16% upside, 34% decline during that time. And again, as somebody who was doing updates weekly back then when the pandemic hit, I can tell you there was a lot of nail biting and concern as we were facing something we hadn't seen for 100 years, which was a pandemic of worldwide proportion. So we can see bad declines intra-year and still have positive returns. Now, year to date right now, and this is year to date, this is as of June 30th we're looking at here. We are down 21% in the S&P 500, but we were down negative 24%. We have 6 more months for this to work itself out one way or the other. Will it end up here on the positive? Will it end up in the negative? Will the intra-year decline get worse or stay the same and we'll just end up somewhere up in here? Those are things that you and I are watching as we try to manage wealth wisely. But to make a decision right now that this is the way it is wrong. This goes back to 2008. It was a negative 38, which was a terrible year in 2008. But as it worked out, we had a negative 49, almost 50% at the low. And if people got out of the market at these lows because they were afraid, they missed opportunities for growth, or maybe even just opportunities to lock in some of the money they had for another time when we had opportunity to buy at sale prices. And I've talked with many of you about that. So please keep this in mind that this show isn't over yet. We've got time to go, we've got information to review, and as we take a look step by step, month by month, week by week, even in some cases day by day, we're trying to make the best decisions to help you make this work out well for you. And any of your thoughts or concerns, as I've talked to several in the last week or so, feel free to call me and let's review this in more detail as it relates to you. Oh, I know why. No, I don't know why. Huh. Oh, there we go. That's why. Technology, anybody can do this. So this is looking at the S&P 500 index at inflection points. And I want to point out a few things to you. I've actually added a few lines to this graph. One is these bars that show where we are as far as high points to low points. So looking back here, this is going back to 1996. We hit a high in 1999, and March of 2000, we were at that point, and then the market fell. You may remember 9/11, you may remember the concerns after Y2K. All of those things came together and made a difficult market environment for us. The market came back up, and then it hit that high again. You'll notice that high happens to be the same high as before, which we're going to talk about more in a few minutes. And then it turned around and went south. This was because of the mortgage bond crisis and the way mortgage bonds have been handled. And then finally it came back up again, and it wasn't until about 2012 that we actually got back to positive territory again and moved on. Now, putting that in perspective, from 96 till March of 2000, we had 106% upside, and we had a 49% downside. 101% upside from 2001 to 2007, and then a 57% decline. Then we had a 401% upside from 2008 up to 2010. And then we had a downturn, I'm sorry, I said 10, I meant 20, 2020. And then we had the downturn in 2020 from the pandemic. And then that, as it worked itself out pretty quickly, we had an upside that went up 114% to January 3rd of 2022. And at this point, we are down about 21% in the S&P 500, which puts us in bear territory for the S&P 500. Notice though, as I said to you last time, we have still not hit the high mark pre-pandemic yet. Yes, we've had a drop, but we still not hit below the high mark of the pandemic, nor are we anywhere near close to the bottom of where we were with the pandemic. So while it's tempting, or maybe fear is driving some thinking, uncertainty, doubt, as I mentioned a moment ago, the reality is we still haven't even hit those marks yet. And so we want to keep clear heads and calm thinking in place as we make good decisions to go forward, which I'm going to share with you why or how I think that works as we look at the future. Now, this chart, and I'm actually going to, let me stop it here. I'm going to take you to, come back here. I'm going to take you to the actual chart online so you can see it. And this is that economic forecast chart. And the reason I wanted to show you the chart is because it's a bit interactive. Here is real gross domestic product, and it's going back to 2020. You'll see that the first quarter we had a negative 5.1, we had a negative 31.2, which is back at the pandemic, at a positive 33.8. I believe President Trump at that point and his administration were saying we were going to have a V-shaped recovery, which we did. Fourth quarter we had a 4.5 GDP growth, 6.3, 6.7. 2021 third quarter a 2.3, then a 6.9. And then last quarter, we had a negative of negative 1.6. We're still waiting for the numbers on Q2, but the estimate right now is a 0.8 positive. Now, whether or not it's that or higher or lower or even maybe a little bit negative, that's still not recessionary. Now, the reason I say that is again, just like I was looking at information for capitulation, we were researching a lot of information for recession, and nobody will answer about recession. While a few people think that it could be now, many think it's going to be later in the year or next year. I don't know how it's going to work out, but what I do know is that I don't think that this expectation looks like we're going to hit that at this point yet. Third quarter, we're looking at a 0.5% growth. Fourth quarter, it is estimated we'll have a negative growth, and then first quarter of 2023, and then moving back to shallow growth periods again. We typically are looking for a 3.0. Now, what that means, if I come back to here a second, is we look at year-over-year GDP growth. So that wasn't strong growth. That certainly wasn't strong growth, nor that, nor that, nor that. That, however, second quarter 2021 was year-over-year strong growth. So even though you might have some weak quarters, the reality is year-over-year can start to change things dynamically. That was strong GDP growth, strong GDP growth, strong GDP growth. Even now, we're still, with one bad quarter, we're still just around the 3. We're 2/3 of it. But that also leaves us with some positive thoughts because we move into the next one. And if we do have, I'm sorry, this is 3.5. Second quarter, if we do, this would be 2.1. But even if we are there, we would be at that 1.6 year-over-year. And again, we don't really get to anything strong again for a while. That again speaks to what I really kind of feel says that we're probably going to be looking at a shallow recession and maybe a shorter term recession. Not like we experienced in the pandemic, not that fast, not that type of a V-shaped recovery, but maybe shorter because again, there are a lot of factors we look at. There are things like the negatives I talked about before, but lower interest rates, even with interest rates rising, there is low unemployment, a lot of cash available to seeking efficient frontiers for investment, a supply chain that will be improving steadily, even if it is slow. All these pieces together could create a positive year-over-year growth, and certainly something that we go over the next, say, 4 to 6 quarters and see some opportunity. I don't know this is what's going to happen any more than anybody else does at this point, but I would say to you, it gives me hope that we are not at the edge of the precipice with a big major fall happening. Now, how does this relate to the markets and the economy. Well, let's go back to the S&P 500 again. And this is a year-to-date review for the S&P 500. If we go back here to right here, January 3rd of 2022, the close on the S&P was 47.96. And the close today, I know it's probably small for you to read. It's even a little small for my eyes to read, but I can tell you it says 39.36. So we're off. That's that 21%. I guess this is above, and we'll talk about that in just a second. But nonetheless, we are down for the year, and it's uncomfortable. It's uncomfortable because of not only the markets and some economic concerns, but also political concerns that we are trying to grapple with to figure out what that looks like. But remember what I've been telling you for the last few months, that what we're watching is how the daily activity is matching up to the 50-day moving average and the 200-day moving average. And a couple of things to note here is that as we look at the highs, going back here, over here and here, we find, and this is where it tried to get up to that day, we find that they're hitting a ceiling of resistance where buyers are pushing the market up and sellers are pushing it down. But you'll notice that it continues to keep coming back to this mark. You'll also notice that the lows are getting higher over time as well. So we're moving into this place where that pressure to move up is starting to look more likely. Now, what I'm going to be watching for the next few days, maybe the next week or two, is does this stay above, you can see here the day was, does this stay above or go above a conversion and then diverge above it and hold it? Because if it does, chances are we'd be looking at it moving up to this place, because while these are what's called ceilings of resistance, these are called floors of support. And so if it goes up, I would think it's going to be somewhere in this ballpark. No guarantees, there's no guarantees with anything, but this would be most likely next place to try to get up to if the market's going to do that. And when I say it would try to get up to it, what it would mean is that buyers are looking at this and saying, well, you know what, maybe there's some opportunities out there. Maybe there's some things I should be looking at. And by doing that, they would be setting themselves up to buy at lower prices to take advantage of opportunities. Now, what I'm considering here is what happens when it runs into the 50-day moving average. Does it break up or does it turn around, head back down south again? And how does it do that? How long, how deep, what's its reaction? If it breaks above and holds it, it's the same issue, just in a more positive way. At the same time this is happening, you'll notice that if we were to have this happen, that going from 39.36 up to 41.65 gives us a recovery of some of our money. And if we go up here to the 200-day moving average, which is 43.60, that moves us back up pretty close, back to January 3rd. We closed at 47.96. If we could manage to get up here to this 200-day moving average somewhere in here, that would put us 8 to 10% off of our high. Now, again, I'm very technical right now, and I apologize for that. I know some of you, you're just wanting me to tell you one thing or another, but I don't honestly know the answers. But we look at the data, much like an airline pilot looks at the gauges and try to get an estimation on what we're dealing with here. But if we were to get to here and it bounced up to this, much like it did in 2008 and then turned south, I would think it's because we're concerned about recession, and we probably try to move everybody back to more conservative positions unless you told us you didn't want to do that. Because I would think that we're in for another few months of pain, especially if we are going into a recession, and we might see it dip down back to here or lower. But again, this is a day-to-day activity. Watching this, making decisions, adjusting accordingly. There's no perfect answer for this. And again, I'm looking at a very broad index. 500 are the largest companies in America. There's all kinds of other opportunities in individual securities and in those 11 industries. Having said that, I can tell you that at this point, I still maintain a hopefulness about where we're headed, at least over the next 2 to 3 months, and then cautiousness over the next 2 to 3 quarters. So hopefully this will give you some insight into where we are, what we think's happening, and where we're going. And I'm pleased to tell you that as I review our accounts with each client, compared to the major indexes, we're not as low as any of the major indexes, unless a client has chosen something very, very aggressive. We're well above that, or at least below that by 1 or 2 standard deviations. And again, we can have that conversation if you'd like to, again, for you as well. Now, with that in mind, let me go back here. And while I'm not going to take time to do it because I want to really get to the next part of what I'm sharing with you, I will tell you that as we looked at the Russell 2000, which is the 2,000 largest companies by industry, and we looked at the Dow, which are the Dow blue chips, as we looked at all those, we see a very similar pattern here for both. We see a movement up, we see a flattening ceiling of resistance, and we see an uptrend in floor of support, and we see everything moving up to a place where I think people are beginning to say, you know what, maybe there's some opportunities here. How long or how far that will go, that's another question that we're going to be reviewing each week, and again, probably in the next update as well. As I mentioned to you before, the four primary engines of the U.S. economic growth are interest rates, which are still low. We're giving it a plus minus right now. Unemployment rates, which are really very historically low, a plus. Business profitability, still businesses are profitable. And GDP growth, which we have only the one quarter, which is negative. If the second quarter comes out as a positive, even if it's shallow, then it'll be a plus minus then. But those are part of the reasons that I can see blue sky as well as some gray clouds out there. Having said all that, I know that some of you have been nervous, and a few of you, but very few, but a few of you have really requested that we get more conservative than we are. And in that case, you're the boss, we're the employees, we'd be happy to do it. But with that in mind, if you are comfortable and everything is working okay, just keep in mind that we're reviewing this with you, and we will go over this anytime you need to. If, however, you want to make changes, really there's only three options we can do. One, utilize assets or securities that are negative correlators to the overall equities market, like the VIX, for instance. We could look at something of that nature. Or we could pick things that only have half or maybe a quarter of the risk of the markets if you like, I can't take this. And so be happy to have that conversation. There's also programs that we have that have stabilizers or riders that give protection to assets or income or both. We'd be happy to have that conversation with you. Which is number two, adjust portfolios to more conservative positions immediately to protect against further portfolio erosion. I again would say to you, I would caution against that at this point, but we're not opposed to it at some point in the near future if we don't start to see some improvement in certain key indicators we're looking for. And as always, third option is continue reviewing the fundamental and technical analysis and adjust portfolios to more conservative positions if/when the fundamental and technical data supports that adjustment, much like we did in the pandemic, much like we did back in 2007, 2008. And then obviously, when the time changes, we're looking forward to opportunities to take advantage of that and get back in and buy it on sale price. So how do we set up the portfolio? The same as always. We've got the 8 circles, which we use for diversifying. We use a trend thinking, identifying an entry and exit strategy and a cyclical management approach based on how the portfolios are weighted. We can make a portfolio much more aggressive or much more conservative, no matter based on how we set up these various circles by how much we put in each one. We call that weighting, W-E-I-G-H-T. By weighting heavier into more conservative or heavier into more aggressive assets, that's how we make this work. And of course, other things like flexibility, cash reserve, income to growth ratio for those of you needing income for your portfolios, probability and surety planning, probability for those that don't need risk stabilizers and protections, surety for those that do, tax management, obviously for anybody who's paying more than their fair share in taxes, we want to take advantage of those opportunities to minimize that and keep more money on your side of the balance sheet. Risk tolerance, making sure your risk tolerance matches your portfolio, or if it doesn't, that you're good with how it's set up. Diversification, that's what we're seeing on the screen here. Dollar cost averaging, for those of you who have a lot of cash, we can take advantage of those opportunities, as we are with some of you, to just put money in systematically over a period of time to give you that growth potential. So now, again, I've said this a couple of times, but I wanted to update it for you. I'm going to close out the portion of our discussion about portfolio management and take you to some of the stuff that I've really been wanting to get to. And that starts with our client-friendly wealth management apps. We've got those in place, and many of you are using them, and more of you are using them each day. Our update webinars. We've been doing these for a while now, and I hear from each of you as you come yourselves, as you invite friends. This is helping you, which is exactly what we want to have happen. Our new interactive website, which is now done, up and running. There's a few tiny tweaks they're making along the way, but it is up and running, and I am so pleased with how it's going to take us to this next level. Our upcoming educational videos, family and finances, and they are starting. We've been taking videos and getting those approved and putting those on the website. We're still in the process of getting that done, but this video tonight is actually one of the first ones we're going to do where we're going to include wealth management processes beyond just investment and portfolio management. We also will have a new phone and tablet app. You'll be able to put the app on your phone or your tablet and be able to get to our website and some of the various sources that we use. The interactive website is set up now for phone and for tablets. It's designed to work on smaller screens. But we're actually going to put together an app that you can just put on your phone and click the Frank Reynolds & Company app, much like that little icon right there, and it'll take you right to the website. We're going to take these videos as soon as we get enough of them. We're going to create a YouTube channel so that people can watch information on a regular basis and learn more about how to deal with things, how to manage processes and wealth management, create, grow, protect, and preserve wealth. That's one of our big, exciting things I'm looking forward to starting as we're doing right now. And then we're going to have a blog and a vlog coming up. And those things will be probably later this year, the first of next year, but I am really looking forward to that as well. There's a lot more, but for right now, I'm just going to leave it at that because that's enough for us to digest. So with kind of updating this, and some of you have seen this before, but I really wanted to help you understand what it is that I'm trying to accomplish with our appointments, with our clients, and with these updates we're doing. We have broken up for our planning clients 3 trimesters, roughly 4-month periods of time. The first trimester, and you'll see the calendar up here, from January to a little bit after, like the 3rd week in April, is all about planning, review, planning, renew. Taking a look at what planning you've accomplished in the past 12 months and what planning you want to accomplish in the next 12 months. The second trimester here is from the last part of June to the first part of September. It's about investment and insurance review and renew, to take a look at what has happened and what we are expecting to have happen going forward in the future. And then finally, the last one, the third trimester, is focused on tax review, both current and long-term tax reduction strategies, as well as estate design, wealth transfer planning strategies. Now, that's how we're trying to work with clients through the planning process to help them maximize their family wealth. At the same time, you do not have to wait for a trimester to come in and have an appointment. We certainly have plenty of time that we'll be happy to meet with you, and that's available anytime outside of these 3 blocks. But this is how we're trying to make sure that we meet all the needs of clients rather than just simply invest and create ROI, return on investment, which is important, no doubt, but we're also trying to create ROL, return on life, and that is what this is about. Now, what I want you to notice is that during the first trimester, our goal will be to talk about, on these updates, investment and insurance strategies and solutions, because what we want to do is talk about things that, quite honestly, during our appointments with you, we may not get to everything. So we want to share ideas with you in the previous quarter so that when we sit down and talk in the next trimester, you are ready to go and you have questions about this or that we talked about in January or February or March. You're ready to go and you have questions about that. In the second trimester, what we want to do is put all of our information to talking about long-term and current tax minimization strategies and estate expense reduction or wealth planning, wealth transfer planning, so that as we get into the third trimester, you've already been thinking about this and you're up to speed. And as we go into the third trimester, we want to talk about planning concepts, and those planning concepts should help get you ready for this discussion. So the goal is to always help you be planning ahead, to be thinking about what you're going to do next. And that's how we're trying to build these. So tonight, I'm going to take the time to start the very first one of these that I've been looking forward to do with you. And that's called wealth transfer planning. Wealth transfer planning is about helping to create, grow, protect, and preserve your family's wealth in today's economy. That's what the whole financial journey discussion and return on life discussion is about. It's not just about how much money we make, but it's how much money we keep. You know, if you make a lot of money, but you give it to the IRS or you lose it in expenses and fees, it's not really helping you. So creating wealth transfer is a critical component to that. Now, the first phase of the process is accumulating wealth. The second phase of the process in our lives, yours and mine on this journey, is decumulating wealth. And the final phase is when we transfer wealth to our heirs, to our loved ones, to the charities that we care about. And that's what this discussion's about. So on the financial planning software, eMoney, that many of you are using, I've pulled up our pretend client, Harry and Mary Arm, and we've put in that with their assets, about 2.9 million with their house and everything, they got investments with a couple of retirement plans and so on, 1.3. Some of you are looking at this going, I don't have this much, and some of you are looking at this going, my goodness, how little is that? The point is that this gives me a plan, a piece to show you something about how we do the estate design calculation. No knock on the fellow professional attorneys who put together estate designs and such. I appreciate so much the documents they do, and quite honestly, I couldn't do that. That's what their expertise is. But one of the things that we can do with our planning software is we can help project into the future what that could look like by using numbers, whether how conservative or aggressive based on that client's investment portfolio, to determine what they could be looking at for total costs. And so in this particular case, we took this out to Harry, age 80, and Mary, 74. We identified what the estate be worth. And so together, if they both passed away, there'd be about 1.45 million to work with, to transfer. Maybe it's more, maybe it's less. It depends on other factors, but this at least gives us a track to run on to say, where would Harry and Mary be in this case? Now, along with that, we're then able to say, okay, so how much goes to our heirs? 12.2 million. You might say, well, that's not enough, or you might say, that's too much for my kids or whoever. Whatever the case is, the point is we can calculate that out, because here's the one I'm more interested in. Whether this is too much for my kids, I know this is too much for the governments, the state, the federal, the county. That's too much. We should do everything we can to minimize that. Now, if we take a look at how that breaks out, what we find is 869,000 of it is probate and estate expenses, and 1.9 has to do with taxes off of qualified plans like IRAs and 401ks, totaling up to 2.7 million. Now, if I told you that with some good planning, we could wipe that out by 50% or maybe 75%, is that something you'd be willing to do? Is that something that if you could reduce what the federal government, what the county government, what the courts are getting, and pass it on to other people that you care about, would that be something you'd be interested in doing? And that's part of what the third trimester is about, helping our clients review their taxes, in this case, longer term, and their estate design to make sure it's matching what their needs are. Now, at this point, I'm sure you're kind of expecting me to spend some time talking about estate tools. I'm going to get there, and I'm going to share with you in a minute, but the truth is we will die. I'm not telling you anything you don't already know. We will likely die at a time we don't anticipate. We can't take any of our stuff with us. Someone else is going to get our stuff, and it's smart to decide before we die who gets our stuff after we die. Otherwise, we let the government make those decisions for us. We let lawyers make those decisions for us. We let arguing heirs make those decisions. So it's much wiser if we do it now, since we know the first one's true, the others are true as well. In that transfer process, there's 4 things that you and I as an individual need to have in place. 1, we have to understand the transfer priorities. Those 4 transfer priorities help us to make good decisions about how we're going to handle taxes, fees, and expenses in the transfer process itself. Number 2, we got to become familiar with legal terms, basic tax rules, and the tools available to help with that. Number 3, we've got to gather the necessary information and data. That's one of the reasons I chose the software we use for our clients' financial plans, because it's already done. We've got that part put together. As we build the financial plan, we can now put all that information together so they can take to their attorneys and their accountants and whoever they're trying to get this data put together with, so they can make good decisions, and then we can extrapolate out in the future what the cost of that could be. And that brings us to number 4, seek competent counsel. Seek wise counsel to help make good decisions. Now, with that in mind, estate planning is what most people think I'm talking about, but I'm really not talking about that. I'm talking about wealth transfer planning. And wealth transfer planning is different in my mind. On estate planning, the impact is on the donor and the estate. That's the highest priority. In wealth transfer planning, the impact is on the beneficiary. That's the highest priority, to make sure that the beneficiary has the best process. Maybe it's the wealth, but maybe it's the process that's more important, as you'll see in a minute. Estate planning typically begins at death, but wealth transfer planning begins immediately. We start looking at processes sooner rather than later, or at least it can begin immediately. The estate planning process is tax and expense driven, and I know I showed you taxes and expenses, but the truth is a good wealth transfer plan is focused on people. That doesn't mean we forget about taxes and expenses. That's a foregone conclusion, but it's the people we're trying to figure out what makes the most sense to deal with, how to manage it best for them. The estate planning seeks to honor the donor, the person giving it, versus the wealth transfer plan is seeking to honor the beneficiary and create the best final stewardship process that a person could do. The estate planning process oftentimes is about retaining control, but the wealth transfer planning process is about transferring stewardship sooner rather than later, and I'll show you why that is the case as well. The last part about it is that estate planning, and it can help with these issues, but I think that wealth transfer planning thinks more accurately about it, and it's EOL, end of life issues. Incapacitation, I physically can't get everything done I need to. Incompetence, mentally I'm struggling to get things done. Death, the actual transfer to the next heirs of whatever's remaining that we haven't transferred previously. And so having a good process for not just the death portion of it, but also the end of life issues, which can be the last 6 to 24 months. And so that, in my mind, is why we're talking about this. Yes, the expenses are a part of it, no doubt, and it's what catches everybody's attention. But as we go through this, I want you to understand that as we look at the 4 P's of a wealth transfer plan and we think about the 6 decisions, it helps us to process this way better. The 4 P's are the people that we want to receive, the property that we want them to receive and have access to, the plans that are going to help fulfill the property being transferred to the people we love and care about, and the planners who are helping to put that in place, both while we're alive and after we have passed. Now, when you put together your wealth transfer plan, there's really 6 decisions that have to be made in the process. The first one is transfer. What do you want to transfer and to who and how? Number 2, the treatment. How should I treat, handle, manage my heirs in the best way possible? Number 3, timing. Do I want this to be a current distribution or a deferred distribution? Do I want to be a lump sum or do I want to be multiple distributions? And if multiple distributions, how many or how long do I want that to last? Item 4, titling. What's the best approach to titling assets for efficient wealth transfer planning and estate design? And how you title them has a lot of impact on how everything works. Decision 5, tools and techniques. What's the best strategy for titling assets to work efficiently with my estate design? The tools, the trust, the various accounts that I've set up. And then number 6, the talk. How to review your wealth transfer plan with your loved ones on a regular basis, which I know that's the one that scares people the most for some reason. But as you'll see when we get to the end of this, not today, this is actually going to be broken into 2 parts. The talk is absolutely critical for them to be able to understand what's going on and to actually help keep your family together better in the end, because that's what this is really about. So understanding the process of wealth transfer, let's begin with people and decision 1, transfer. There's 3 issues to consider. Tradition. I have 3 children, therefore I must divide it 3 ways. Well, maybe that's the case, but maybe instead of tradition, you should look at dependency. Let's suppose that one of my 3 children is a world-renowned brain surgeon, and they have plenty of wealth, and they really don't need anything from my estate. Maybe, on the other hand, I have a child who has a job, they're a missionary, or they're a teacher in a school where they don't make a lot of money. Maybe dependency is a better decision. Now, granted, if I'm not going to leave something to my world-renowned brain surgeon son or daughter, maybe I should talk to them about that. Matter of fact, for certain, I should talk to them about that, because I don't want them to think this is that I didn't love them, but rather that I felt like I've already given them part of the inheritance early as I've paid for school and helped them through that. And that because of dependency needs, I'm helping their siblings, but not out of anything other than love for all 3 of them. Which brings me to number 3, is that love. All these decisions should be made based on love. Who do I love? What's the best way to take care of them? And what's the best result or outcome I'm looking for? There's three giving choices you and I have: heirs, charity, and taxes and expenses. Let me start with the last one first. If I don't do proper planning, the last stewardship decision I get to make on this planet will be impacted by governments, state, federal, by fees through the courts, expenses, etc. But if I start planning ahead, I can actually disinherit the IRS and disinherit other expenses and fees and leave more to heirs and to charities that I believe are accomplishing things that I care about. But that requires us making good decisions sooner rather than later. The three questions to consider when I'm putting together my transfer plan on the transfer thought process is this. One, as I'm looking at a person to give resources to, what's the worst or best thing that can happen if I transfer wealth to, and you put their name there? What's the worst thing that would happen if I transfer something to my son, my daughter, my grandchild? What's the best thing that could happen? Then number two is, how serious is that? Is it really serious? Is that a really serious concern? If it is, then it should inform me as I make decisions going forward. How likely is it to occur? If it's a strong likelihood it could occur, then we should be making the best decisions possible. Now, on the other hand, if it's not that serious and we're building a mountain out of a molehill, then maybe we don't have to worry about it. But as we take a look at how we want to transfer wealth to that next generation, those heirs and charities, and disinherit the IRS, this is all part of that process to create a beneficiary-centered approach. So still looking at people, we're moving on from transfer now to treatment, because this is about how we're going to treat people. So the first thing I'm going to suggest to you is this: you love your children equally, so treat them uniquely. And then finally, it's my encouragement that you do your giving while you're living, so you're knowing where it's going. And I know that's goofy, but I'm going to tell you, if you hand money to somebody now and you watch what they do, it can instruct you immensely on what they'll do with it, but it can also give you a chance to have a conversation to maybe help tweak that process to improve it, and then to identify what you should do as you go forward with this. My encouragement is, don't use money to manipulate behavior. I don't think that's going to work. I've watched it tried, and I don't think that works. Don't use it to change lifestyle. Try to be careful not to make their lifestyle any way worse than it is now. Don't destroy the need to provide. I think it is Warren Buffett who said that he wants to give his children enough money so they can meet their needs, but not so much that it destroys their need to provide or to grow and change. Don't give money in a way that comes between husbands and wives. Put it together in a way that strengthens their relationship. Or don't give money and don't use money to come between parents and children. Work with the best process to bring together a unity in that discussion. And don't get in the ways of heirs' emotional development and financial maturity. Because I don't know about you, but when I was 40, I wasn't nearly as astute or thoughtful or caring about how I handled finances. When I was 20, I was even less. I've developed through that process, and giving too much or too little would have actually hurt that process. So be careful how you transition wealth and such to others, because what you're trying to do is to create the best outcome for their maturity and their development. Don't be manipulated by children or heirs' demands or expectations. Just because a child thinks this is what you should do does not mean that's what you have to do. You're the steward. Don't avoid your stewardship responsibility. The wealth is your responsibility, and the decisions are up to you, not them. And don't let your beneficiaries be surprised by your estate planning decisions. As you put together your trust, your will, your different types of accounts, let them know what's going on so that they're not surprised. This goes back to the talk. Maybe they won't like it, but it's going to come much better from you than it will from their siblings or from a professional trust or administrator. Consider the importance of seeking personal and spiritual guidance in your decision making. I just had somebody today that was talking about how they were going to visit with their pastor regarding some financial decisions they were making. Also, counselors, professionals, people who can impact that conversation well. Be in unity if you're married with your spouse, so that together you stand with a unified front about how to handle things. Seek counsel from your advisors, those people that you currently trust. Find out what they think about the process and see how they can bring good pieces and tools to this discussion, whether it's the people, you figure out the people, the property you're dealing with, the plans and the planners. Let those people help you in that process. And consider the importance of talking with your children. I share, let me just make sure where I'm at here. I'm gonna come back to this. When it comes to talking with your children, it's important to understand something. I've shared this before. I'm going to share it here because I think it's critical. If one of your children came to you and said, hey, I need $25,000, and you were in a position to give them that, but as you looked at what they wanted for you, considered the process, you're like, no, I'm not going to do that. They're going to go away disappointed, maybe even angry a bit, but they'll understand the fact that that was your money and it was your right to say no, even if they didn't like it. Imagine, though, that you have put that child, one of their siblings, in charge of that, and the same child comes and asks for the same $25,000, but this time it's his brother or sister who's talking to him. And they say no, and they have exactly the same rationale as you do. But this time, the child goes away with a different feeling. Yes, they're angry, but this time it's their sibling keeping their money from them. Not you making decisions about your money, but their sibling keeping their money from them, their brother or sister saying, no, you can't have it, and create an enmity between them. That's why talking with your children as part of your wealth transfer plan can really help to create a smoother transition along the way. That means is as you're choosing a personal representative and or trustee, you have to consider people's availability, their qualifications, whether or not there's going to be interpersonal conflicts in the process. You have to define the roles of family members so everybody understands where they are. And I would suggest don't rule out banks or trust companies, because it's much better to have all of your children sitting on one side of the table and a bank administrator sitting on the other side, or a trustee sitting on the other side. That way they can all join together and be disappointed in that person. And you can set up rules and regulations that make it so that person can be fired, a new person can be put in, but they'll always still have to follow the requirements of your trust that you have written up. And that's a whole different discussion. Just understand that while they may not like the person, the plan you're going to put in place can't be changed. And so you want to make sure that you put very good thought in how that whole process works. If you have minor children, choose a guardian or a minor child or a child with special needs. Define the lifestyle you want for your children. Considering people with no children, when you find somebody who has no children, talk with them, because maybe they don't want children. Maybe they would do it, but really listen to them. And if they don't want children, that's probably not going to be the best outcome. People with 2 children, for instance, maybe they just wanted 2 and that's it. Maybe they would take more, but have that conversation with them to make sure that makes sense. Considering people with older children, maybe they're looking at this time now, they're going to be able to spend time together where they couldn't before because they were raising children. And bringing your minor children or your special needs children into that situation may not create the outcome that everybody wants. So when you're talking to them, try to give them an out to understand that no is an acceptable answer, because you want this to be the best for your children and for the guardians. And I'd last consider the role of grandparents. Grandparents a special role. Grandparents get to give them candy and cookies and things they couldn't do with you when you were a child, and they get to send them home, or they get to give them money and help out, and they get to send them home. But maybe they just want to be a grandparent. Maybe they're not really wanting to be a parent again. So have these conversations carefully and with consideration and compassion to make sure that the people involved, it makes sense for everybody involved. Now I'm going to stop there, even though there's more, and I'm going to continue Wealth Transfer Planning Part 2, how to create, grow, protect, and preserve your family's wealth in today's economy, as the second part of our August update. Because I think this is critical for you to be able to make good decisions as you try to figure out how to do a transfer plan, how to wisely handle end-of-life issues, how to make sure the process is focused on the best outcome and results for your beneficiaries, and how to make sure that it takes care of you, and if you're married, your spouse, while both of you are alive and need these resources. So we'll finish this up in our next discussion where we'll talk more about tools and techniques and the talk, etc. Hopefully, this has given you an understanding of one of the reasons that I have been so focused on talking about the financial planning piece of what we do. Because growing wealth through investment, protecting wealth through insurance and risk management, that's clearly an important piece of this discussion. But more wealth is lost to wealth transfer plans or estate designs that fail. More wealth is lost to interpersonal conflicts within families. More wealth is lost to all kinds of external forces than ever has been lost in the stock market. Yes, wealth has been lost in the stock market, but the planning piece, the personal and the financial planning piece of this is really designed to help you make the most of this. And wealth transfer planning is just an important part of that process for the transfer. So now as we come to the end of our presentation, our program today, I want to remind you of the 4 complementary wealth management apps that we use to help you manage wealth wisely for your family. I shared this with you last time. If you go to the website, and actually you can go right here to log in, and it'll take you right to this page. This is your wealth management dashboard. This is your investment management dashboard for portfolio management that we do with you. This is your risk reward assessment that helps us understand how your risk tolerance works with the investments you have with us and the investments you have outside of us. And this, your personal life planning, attaches feelings to your return on life that then blends well with your numbers to help you get what you want. We're wanting to maximize return on life. As I've said countless times before, as you and I take our last few breaths of air on this planet, we're not going to think about it. I'm so glad I have all this money, or I'm so glad I made that rate of return. We're going to be thinking about, what did we do with those resources? How did we accomplish things that are important to us? So again, you can go to our new website, click on login, it brings you here, and you can access your wealth management dashboard, your investment management dashboard, your risk reward assessment, and your financial life plan through here. If you currently don't have one of those, then just email us and let us know, and we'll be happy to get you a link for that. So now, let's see if there are any questions out here. Oh, that's me. That's not what I'm shooting for. Let me do this here. There we go. I don't see questions. I thought I saw something earlier, like a hand up or something. I guess not. Let me go ahead and change this now back to what it was. There we go. So again, if you have questions, I'll ask one more time before we close out. But you can, as always, you can email info@Frank's office. We'll be happy to get that to you. We can do online chat, or there's this thing called the telephone. You can call and be happy to talk with you about that. Even schedule time for an in-office visit, a webinar, or just on the phone. Be happy to do that, to answer questions, to help you maximize what you're doing. So our next financial journey update, which will include part 2 of the wealth transfer plan, will be August 23rd, and we'll be covering a number. We'll talk a market update for sure, and we'll be talking about the second part of the wealth transfer plan also. So here's what we've covered. We covered the market and economic review, portfolio management diversification considerations. It's a mouthful. Understanding the power of wealth transfer planning process, our apps, your questions, although I just saw one pop up, and then the next investor update. Let me see what we got here. It's a question. Oh, you're welcome, Curtis. Let me just make sure here there's not more to that. But I appreciate your kind statement. Okay, very nice. Thank you so much, Curtis. Yes, absolutely. We're trying very much to help you maximize what you're doing. So as always, if you would like to invite your friends to our updates, you are welcome to do that. For those of you who have attended the accredited investor update, that requires a special sign off that guests have to do. But in this one, the regular one, the third Tuesday of each month, everybody is welcome. You just got to let us know so we can invite them and Kayla will be happy to send them a special webinar update so they can then see what's going on and understand what we're about to talk about. So hopefully that will work for you, that you can join us. And I thought that was the last one. So in closing out here, I see it's right at 6:30. I got this done. Hopefully I didn't talk too fast. I was worried I might speak at high velocity, and I didn't want that to happen. I've been told that I speak at about 500 words a minute with gusts up to 800, and I was trying to keep it even so that everybody could hear what I was saying. With that in mind, again, as always, I hope you understand how, while I do see some gray clouds out there, I also see a fair amount of blue sky, and I am excited and hopeful not only for what I think is happening over the next 12 to 24 months, but also what we're doing as we work with each of you individually. And I can't wait to have that conversation with you. As I would say in the past, and I really believe this, I just, like you, pray that God blesses America. I pray that God blesses you and your family, and that you can work to accomplish all aspects, return on life, so that you can feel very good about how things work out as you and I come to the end of our life issues. And so with that said, I hope you have a fantastic week, and I will look forward to talking to all of you very soon. Thank you, and have a great night. God bless.